Welcome back to Talk Tickers. We're your shortcut to understanding what's really going on behind the numbers in earnings calls. Today, we're doing a deep dive into CRA International, that's CRAI. They just dropped their Q3 2025 results. They're the big professional services firm, economics, finance, management consulting. And honestly, it was a really impressive print this quarter. So our mission today, cut through the jargon, pull out the key numbers, see what management said, and figure out what it all means for the investment thesis. The market loved it, which tells you something right off the bat. Strong results, and maybe more importantly, it hints at real durability.
Yeah, durability is definitely the word. CRAI delivered a really clean beat, just strong across the board, great top-line performance, sure, but also excellent operating leverage. Let's hit those numbers that got the market excited. Non-GAAP EPS, $2.06. The street was looking for $1.80.
Wow, $2.06 versus $1.80. That's what, a 14% beat?
Exactly. A huge beat on the bottom line.
Yeah.
Really significant.
Okay, 14% is massive, especially for a consulting firm like this. How'd they pull that off on the revenue side?
Revenue was strong, too. Came in at $185.9 million. Consensus was closer to $179.4 million. That's a nice 3.6% beat there. And it represents, get this, 10.8% year-over-year growth.
10.8% growth, okay.
And the key efficiency metric, utilization, held up really well. 77% for the quarter. Very strong.
77, okay.
All that good execution, it drove non-GAAP EBITDA up to $24.4 million. That gives you a pretty healthy 13.1% margin.
Right, and I think management pointed out, didn't they, that Q3 plus Q1 and Q2?
Yeah, year-to-date fiscal 25, these are the three best revenue quarters in the company's history.
That's the durability point again. This isn't some one-off lucky quarter. It's just they found a really strong, consistent rhythm.
Absolutely.
Okay, so let's unpack that growth engine. When a company beats like this, you always want to know why. Was it one giant project or something more fundamental? Geographically, by practice area, where did the strength really come from?
Well, what's interesting is just how broad it was. This wasn't about one single practice carrying the load. 7 out of their 11 practices actually grew year over year.
7 out of 11.
Yeah, and 4 of those were real powerhouses posting double-digit revenue growth. We're talking antitrust and competition, energy, finance, and intellectual property, IP.
Double digits in 4 separate areas, that's impressive breadth.
But if you had to pick a star performer, you'd have to look internationally.
Oh, really?
International revenue was up a massive 30.3% year over year.
30%? Wow.
Yeah, 30.3. And just to put that in context, North America grew too, which is good, but only at 6.8%.
Okay, so international is just leagues ahead right now.
Sharply outpacing the core domestic business, yeah.
Why? What's driving that huge difference? Why is the international scene so hot for them right now?
Well, management pointed specifically to antitrust and life sciences work overseas. But the key factor, they said, is what you might call regulatory flooring.
Regulatory flooring?
Yeah, think about Europe, for example. Regulatory environment there, especially around antitrust and competition, has been pretty consistently pro-enforcement. That consistency creates a stable, almost mandated demand. Companies have to respond.
Ah, I see. Unlike maybe in North America, where regulatory focus can kind of ebb and flow a bit more with political cycles, creates more stops and starts.
Exactly. That European consistency gives them a reliable baseline of work. It makes the demand less cyclical.
That makes perfect sense. That difference between, consistent mandated defense spending versus maybe more discretionary projects, that's key to understanding CRAI's resilience. If regulators are active, companies just have to hire firms like CRAI for defense, pretty much regardless of the broader economy.
Precisely. And you see that kind of mandated spending feeding through the whole legal and regulatory segment. That part of their business was up 11.5%. Management even noted that, things like total case filings and court judgments were up by double-digit percentages compared to Q3 last year.
Right. More legal action, more need for their specific economic expertise.
Exactly. More mandated work for CRAI.
Maybe we can make this more concrete for you listening. Give us some specific examples of the kind of work they're doing.
Sure. So in antitrust, they were advising United Health Group during that big DOJ review of the Abacus acquisition. Pretty high-stakes stuff, helping them navigate the litigation and reach a settlement.
Okay.
And internationally, sticking with antitrust, they were supporting Microsoft during the European Commission's investigation into the Teams platform. Another big one.
These aren't small projects, are they? These are complex, high-profile cases where getting it wrong costs the client a fortune.
Absolutely. That's why they can command premium rates and why clients rely on them so heavily.
Right. And you saw a similar dynamic in intellectual property, didn't you?
Yeah, definitely. They had an expert testify on reasonable royalty damages in a patent dispute. This one was about the mRNA COVID-19 vaccines.
Yeah.
And that specific engagement, their expert testimony, it contributed to a global settlement involving a $740 million payment plus ongoing royalties.
$740 million. Okay, that's demonstrating real, tangible value from their specific expertise.
Huge value creation. And that IP case also points to another important trend, this increasing need for cross-functional work.
Meaning projects that don't fit neatly into just one practice box.
Exactly. The really complex stuff rarely does anymore. Take their energy practice, which was also booming this quarter. They worked with a major California utility on, integrated resource plans, super complex balancing act, the grid, reliability, hitting decarbonization goals.
Okay, energy makes sense.
But then linking back to that cross-functional idea, they're also doing due diligence for private equity folks investing in digital infrastructure. Think data centers.
Right, data centers. Huge energy users.
Massive energy users.
Yeah.
Arguably the biggest operational cost now. So doing due diligence there needs deep energy market and regulatory knowledge. That's the energy practice.
Yep.
But it also needs complex financial modeling, risk assessment that brings in the finance practice.
Got it. So they're pulling expertise from different teams.
Yeah. Another example they gave was bringing their competition and transfer pricing teams together. They were advising a major mining company, making sure its internal pricing didn't accidentally trigger antitrust issues.
That kind of integrated, complex work really locks in clients and justifies the higher rates, I imagine.
For sure. It's their sweet spot.
Okay, speaking of complexity and rates, let's pivot a bit. Let's look at operations, particularly headcount. You just told us revenue is at an all-time high, utilization is running hot at 77%, but consultant headcount was actually down 1% year over year. That sounds, well, contradictory. Aren't they stretching their people thin, risking burnout?
Yeah, it's a great question, and it gets right to their strategy. Management was really clear. This isn't a sign of weakness or shrinking demand. They're being very deliberate, redeploying people and focusing hiring almost entirely at the senior level, at the top of the pyramid.
The VP first strategy, right, hiring the rainmakers.
Exactly. They brought in nearly 20 new vice presidents just in 2025.
20, wow.
Yeah. And the thinking is, you hire the proven VPs first, they bring in the relationships, secure the high-value projects, start generating revenue quickly, you let them ramp up, get their feet under them, then you build out the junior consultant teams underneath them later.
Okay, so it meets the immediate high-margin demand with the existing, maybe slightly stretched workforce.
Right.
While setting up for longer-term growth driven by these new VPs. Then you backfill the junior ranks.
It's a strategic play. Higher utilization risk maybe in the short term, but with the promise of better margin expansion later when they leverage those VPs with more junior staff.
That feels like a pretty sophisticated approach, quality over just sheer quantity of consultants.
And that quality focus is also reflected in their pricing power. Bill rates were up about 3% effectively in 2025.
Which is right in their target range, isn't it?
Yeah, bang on their usual 2-4% annual target. And the fact that clients are paying it seemingly without a big jump in write-offs or anything, that tells you clients see the value. They see CRI's expertise as essential, worth the price increase.
Okay, so strong operations, pricing power. When you connect that to how they're handling their capital, the message seems pretty clear. Confidence.
Oh, absolutely. Resounding confidence. Look at the dividend. They hiked the quarterly cash dividend by a massive 16%, up to $1.57 per share.
16% dividend hike. That's aggressive.
Very. And in Q3 alone, they returned $7.2 million to shareholders. That was split $4.0 million in buybacks.
Okay.
They bought back about 22,000 shares at an average price around $185, and then $3.2 million in those dividends.
So buying back stock and hiking the dividend?
And cleaning up the balance sheet. They paid down $25 million on their revolver, ending the quarter with net debt around $72.5 million. Very manageable.
So strong cash flow is funding both shareholder returns and debt reduction. That's a good place to be.
Definitely signals strength and confidence.
And that confidence naturally flows right into the updated guidance for the full year 2025. They raised the outlook, right? Presented on a constant currency basis.
They did. They nudged the revenue guidance up. The new range is $740 million to $748 million.
Okay, up from
the prior $30 million to $745 million range. So tightening and raising the bottom end.
Got it. And margins.
Non-GAAP EBITDA margin outlook also got a little tweak. The range is now 12.6% to 13.0%. Previously, it was 12.3% to 13.0%.
Yeah.
So again, raising that lower bound slightly.
Okay. And we should probably remind you listening, the fiscal year actually ends January 3rd, 2026.
Right, which means Q4 2025 actually has a 14th week this year. That definitely helps that raised forecast a bit. It's factored in.
Good point.
And despite the usual boilerplate language about global macro uncertainty, politics, all that.
Which everyone has to say.
Right, standard CYA. But management was pretty firm about their competitive position. They explicitly said they have not seen any slowdown in projects, any contraction because of shifting U.S. antitrust stances.
Which circles back to that mandated demand point again.
Exactly. It underscores that their core work seems somewhat insulated from the broader economic jitters. It's less discretionary.
Okay, that paints a really strong picture. Let's shift gears now. It's time for a segment that's purely for fun, pure concept, pure entertainment. This is not financial advice. If we were analysts walking into a hedge fund meeting right now, pitching a bold idea based only on the CRAI Q3 call, what's the outrageous but plausible trade?
Okay, the pitch is go long CRAI. Simple enough. But the thesis is about a convergence. Two powerful structural tailwinds meeting an expected capital return kicker. We're essentially betting on a double layer of that mandated legal and regulatory spending we talked about.
A double layer. Okay, I like it. Lay out the catalyst for us.
Okay, catalyst one, regulatory flooring and consistency. We hit this, but it's crucial. You've got that consistent pro-enforcement stance internationally, especially Europe, providing a really high, reliable base demand. And domestically in the U.S., whatever direction antitrust enforcement eventually takes, clarity itself guarantees work for CRA. Companies will need to adapt, defend, comply. It drives non-cyclical demand for antitrust and IP services.
Right. The spending isn't optional for clients, it's required. So demand is pretty inelastic. What's catalyst number two?
Catalyst two, the IP and AI overhang. We're betting that intellectual property fights are only going to get more complex, especially around huge new areas like artificial intelligence. Think about the disputes that will arise there. And CRAI just proved, with that massive mRNA vaccine case, they can handle these incredibly complex, high-value IP battles.
And that complexity requires that cross-functional expertise you mentioned.
Exactly. It plays right into their strengths, drives the highest margin work, and concentrates revenue in these critical areas.
Okay, so two strong demand drivers. What's the execution piece? The kicker, as you called it.
The execution, the thing that could drive near-term share price pop, is capital return. Look, they just hiked the dividend 16%. They're paying down debt. They clearly have excess cash and they know it. So the pitch includes forecasting the announcement of an accelerated share repurchase program, an ASR, probably early in 2026.
An ASR. Okay, for listeners maybe less familiar, why is an ASR potentially more impactful than just their regular ongoing buyback?
Well, an ASR is usually a big one-time deal, often done through an investment bank. They basically retire a large chunk of shares almost immediately. Unlike the slower drip of open market buybacks, an ASR gives instant visibility to a much lower share count. That immediately boosts earnings per share, which the market loves. It often forces a quicker re-rating of the stock, faster than just waiting for organic growth.
Oh, okay. So it pulls forward the benefit of the buyback, potentially creating a more immediate catalyst, shifts it from just a long-term story to a nearer-term event.
Exactly. That's the trade idea. High conviction.
That's a compelling pitch. Okay, so wrapping this deep dive up, the key takeaways from CRAI's Q3 seem to be broad-based growth firing on multiple cylinders, hitting a record revenue run rate, management confidently raising guidance, and backing it all up with an aggressive capital return policy. It all signals real strength and durability.
Yeah, the quality of the business really shone through, and the management messaging seems perfectly aligned with shareholder value creation. The market certainly agreed.
And maybe linking back to that operational strategy, that VP hiring. Here's a final provocative thought for you to chew on. They brought in nearly 20 senior VPs this year. Those folks are hired to bring in business, right? Rainmakers. So how quickly will the new complex projects they land force management's hand, force them to accelerate building out that junior consultant pyramid underneath those VPs? And what does the timing of that influx of lower cost junior talent mean for future margin expansion? That rapid leveraging could be the next big catalyst for margins down the road. Something to think about. Okay, that's our dive into CRAI. As always, remember this was purely educational, just exploring the earnings call. It is absolutely not investment advice. Thanks for tuning in to Talk Tickers.